welcome to today's webinar, Fintech and Consumer Regulations in the new Trump administration. We appreciate everyone's time being here with us today. I would like to just begin with a few rounds of introductions. So I am Brandy Reynolds. I am the Chief Growth Officer and Senior Managing Director of Bates Group. I will be your moderator today, and I would love to take a moment to introduce our very talented and skilled panelists. I will turn it over first to Eric, and then we'll just go through and we'll like everyone to say just a few words about themselves and experience, please. Thank you.
Thank you, Brandy, and thanks for having me here today. It's good to virtually see everyone, at least. I'm Eric Goldberg. I'm a partner at Akerman. We're a national law firm, and I am based in our Washington, D.C. office in our Consumer Financial Services Data and Technology practice group. I've been here for about 6 years, and before that spent over 6 years at the CFPB. We work with clients in the fintech and financial services space, including money services businesses, and money transmitters, lenders, buy now, pay later companies, B2B, card issuers, crypto companies. We're working a lot lately with stablecoins. So work on the range of issues that those companies face, including at the federal level, supervision and enforcement matters, and state issues, as well as licensing and commercial arrangements. And again, really happy to be here today.
Kathy.
Oh, it's hard to know which way to go. I'll start. I'm Kathy Tomaszewski. I'm the Executive Director of the Money Service Business Association, also known as MSBA. We are an organization for non-bank financial institutions, and I am proud to say that in September, we will celebrate our 10 years. And with all the different products and services that Eric noted that his firm covers, I will say that we have seen extraordinary growth in our trade association to also incorporate those companies into the association. We work very closely with the state regulators, the Conference of State Bank Supervisors, as well as the Money Transmitter Regulatory Association, to help stay up to date on what is happening in the states and how that will be affecting our companies. So thank you, Brandy, for inviting us. We're excited to be part of this great panel.
Thanks, Kathy. And hi, my name is Jim McCarthy, and I'm the chairman of McCarthy Hatch. We are a technology and consulting firm in consumer compliance and regulation. We focus on banks and consumer financial institutions under the purview of the CFPB. And our technology predicts risk through the eyes of the consumer, which helps identify and mitigate risk before it becomes systemic. And I'm super happy to be on this panel today. Thanks.
Hey, thank you all so much. So let's move forward and just give a little bit of insight into the agenda, things that we hope to cover today. Changing regulatory environment, what to expect. Money services businesses and money transmitters, what's changing. Consumer sentiment in financial services. Legislative and regulatory trends to watch. Compliance and risk considerations for financial institutions. The future of fintech regulation, what's next. The role of state versus federal regulators in fintech oversight, and a case study and industry insights. We will have some time at the very end for questions. We did receive some questions that were submitted to us prior to the start of the webinar. So please do let us know if you have anything that pops up, and we'll try our best to get to those during the webinar. If not, we will try to do an email follow-up with as many questions answered as possible. This is a reminder that we are also offering some continuing legal education credits for the webinar. So there will be a code and information at the very end. So stay tuned for some more information about that. Okay, so we will go ahead and move right along into our first topic here. So would like to first kind of jump in. This will be kind of geared towards all of the panelists, but want to look at the changing regulatory environment. And so some areas that we're going to discuss are on the slide here today, but would like to have maybe Eric look at the first question that we have. What regulatory changes do you anticipate under the new administration? So I know that's a loaded question, but feel free to kind of take that maybe from a high level. We do have a lot of slides where we'll get a little deeper as we go through.
Sure. Thank you, Brandy. And yeah, anyone who can predict the future, particularly right now with any degree of certainty, is willing to take more risks than I am. But I think we can say at one level, there's going to be certainly more uncertainty, and there's certainly an emphasis towards deregulation, but that is not uniform and across the board. We're going to talk a little bit later about, FinCEN's recent actions and the geographic targeting order that's added burden to a lot of the companies that are participating in today's webinar. And, a lot of the focus lately has been on the fate of the CFPB. It started at the very beginning of the administration with Elon Musk saying the CFPB is dead. CFPB's website was still working as of a few minutes ago, and employees are still being paid, but most of them are not doing any work. And that is pending a court decision that's expected next week. And if you're, a compliance officer or, working in a company trying to figure out what to do from day in and day out, remember, whether or not there's a CFPB, the laws that the CFPB implements and enforces have been on the books, most of them for decades, and long predate the CFPB. So if you're a lender and you need to comply with the Truth in Lending Act, or if you're a money transmitter, you need to comply with the Electronic Fund Transfer Act. Those laws aren't changing. There's no proposals to amend those laws in any significant way. So if depending on your industry, you really need to be focused on, what are the things that apply to us? Have any of them really changed? Now, as things move forward, there is going to be a lot of tumult, so there are at least 12 CFPB initiatives from the last year that are under close scrutiny that people are expecting to change, but will all 12 of those be repealed and rolled back? I can't say with any certainty. Some of those, for example, the 1033 open banking rule, I can imagine versions of that rule staying around. Others, the administration has already signaled, may go away, for example, around overdraft fees. But and just as one example, President Trump during the campaign talked quite a bit about putting a cap on credit card interest rates, and presumably, that is additional regulatory burden. That's not a deregulatory effort. So, and there's obviously some bipartisan support for that sort of initiative. So I think a lot of the focus in the short run is going to be on the tumult around the CFPB. I don't expect that to actually necessarily impact any companies on a day-to-day basis unless you have an ongoing exam or enforcement matter. And then at the same time, there's going to be a focus on what happens with all these various initiatives from the last administration. The new director is going to be confirmed shortly, and I probably will have more substantial public statements on what the Bureau's position is. They've really only had to speak on things so far when they've been forced to by one of the many court cases pending against the Bureau. So I'll stop there. I'm sure we're going to touch on a lot of these other topics again in the future.
And so, Kathy, a quick question for you. So would you have any advice for financial institutions, fintech firms that are looking to figure out how to actually navigate right now during some of these times of uncertainty? So what advice would you have to them?
So my advice would be similar to what we did with the crypto companies early on when companies were very uncertain about the federal regulation. They became licensed in the states, and those companies, I think, are performing solidly and have the protection of the state regulation. I do anticipate if, I've heard discussions, I've just come back from 2 states, if the regulation is so weakened, I'll say at the federal level, that the states will have to step in to protect their consumers. As always, the states believe that it's their first right to protect their consumers. So we may see strengthening of the regulations or the enforcements or interpretation being done at the state level. One thing I would like to add that I think is, a silver lining perhaps, is that we are seeing a lot of discussion on, from the Senate and the House about debanking and putting forth, and dispelling sort of myths about high-risk individuals and regulators, putting forth their enforcement actions or requiring companies to debank certain types of products and services. We may see, a more open banking environment from the regulation perspective there. that will benefit, I think, all of the companies, that are operating in a legal, risk-based, well-documented compliance program area.
Very well said there. And I know, Jim, you're going to have probably some thoughts here. So I'm going to go ahead and move to the next slide. But in regard specifically to the CFPB, so now what? And I know you spent a lot of time discussing this very topic. There's just a lot of concern and actually just people wanting to really get as much good information and insights as possible. So I'll let you kind of lead in with this slide here as we're talking about what's changing specifically with money services businesses. So what are your thoughts here? What's up with the CFPB?
Yeah, thank you very much. And I appreciate that. I don't know, right? And none of us really do until the new director gets approved and we have some direction, as Eric mentioned earlier. We won't really know, but we can look at the fact patterns, right? So I'll just really quickly say that when I advise my clients, I try to remind my clients that regulations didn't go away, as Eric mentioned. We still have regulations to follow, and then I try to remind my clients where their regulatory risk lies in terms of enforcement. And we start to look and we see the states, right? And we see other bodies. And so all of that is still in existence. We still have to adhere to those regulations. And so status quo is the most important thing for me when I advise my clients is to stay the course, remembering look back periods and remembering what we do today will be evidence tomorrow. It's important to just maintain your compliance composure and monitor what's happening in the Bureau through how they communicate with the new director, which hopefully will be very soon.
So Eric, can you give a little bit more insight from your perspective on those potential shifts in this new administration and any potential impacts for MSBs specifically, or even crypto related MSBs, because that is also kind of the hot topic or segment right now is crypto.
Yeah, so probably important first to take a bit of a step back and sort of where are we right now. So if you recall, as I mentioned before, there was an announcement that CFPB was dead. There was an immediate lawsuit filed by the employees union and some other entities to block the administration from basically eliminating the CFPB. And there's been a number of court hearings in this case, and it's boiled down to the court trying to encourage the court to say that by the plaintiffs, that the CFPB is required to do certain activities by statute. I think they counted over 50 different things in the Dodd-Frank Act that the CFPB is quote unquote required to do. And in the court order that's expected, I don't know exactly what the judge will do, but I'm expecting her to say something along the lines of, if the statute says you have to do something, CFPB, until Congress changes that statute, you still have to do those things. But what that means in practice, is very different could be very different. So just a couple examples. There's been a lot of discussion about the consumer response function, which Jim knows very well. The statute says the CFPB is required to intake and review consumer complaints. So a lot of the focus has been on maintaining the infrastructure to intake complaints. But the statute also says the CFPB shall enforce these various laws and shall examine companies. So money transmitters, for example, that send more than 1 million transactions are subject to supervision by the Bureau. But the statute doesn't say how many exams the CFPB should do or how many enforcement actions it should bring. And even under Democratic administrations, they didn't supervise every entity every year. And so the new director, I'm expecting, is going to have a lot of discretion in how big his supervision and enforcement teams can be. And I would expect be allowed to shrink the size of those teams quite substantially, even if not eliminate them entirely. So I still expect there to be enforcement and supervision. And if we look back to what happened under the last administration, or last time Trump was president, under Kathy Kraninger, they actually brought more actions against money services business than they did during Democratic administrations. And most of those actions were really on technical violations. So you didn't give the right disclosure, you didn't have the proper procedures in place, versus the sorts of cases we saw during the most recent administration, which were bigger, more complicated, arguably more controversial cases, for example, around whether Zelle is permitting too much fraud on its system, and cases, cases against big tech companies. So I would expect to see, the extent that there is enforcement, it's going to focus more on those sort of technical violations as opposed to sort of industry shifting actions. But again, who knows?
And I definitely think that'll be the theme throughout, right? Is that we don't know. I picked up earlier that you noted, as of just before the webinar, you checked and the website was working. So I think right now it's a lot of real-time reporting as to what's happening, because there have been so many changes.
And I will say, we have seen from clients in the last month that there have been occasional interactions with bureau staff who appear to be performing some portions of their job. So it's an ever-changing landscape. And the CFPB is, they've dismissed a number of enforcement actions, but they've kept a couple, particularly those that involve the Military Lending Act.
And Kathy, do you have any insights from the state level licensing perspective specifically? Because I know there's been quite a bit of concern and just what's going to happen from a state level perspective as well.
So from a state licensing perspective, we have been working for the last 2 years with CSBS on the pushing out the implementation of the Money Transmission Model Act, MTMA. There are 24 states that have enacted that in some portion. This year we saw a slowdown with the new administrations coming in, even at the state level, right? It's harder to get a sponsor for a bill that is, even though the bill, it's a bipartisan bill, it's not a very, I call it sexy bill, a 43-page dull and boring prescriptive thing about how you should moderate. So we have 6 states in play this year. We have Alaska, Colorado, Hawaii, Mississippi, Nebraska. Virginia has passed it, and it's on the governor's desk to sign. I'm not sure what's holding that process up. So in those requirements, they haven't harmonized, as I'll say, smoothly as was the intent, with the way the legislators have sort of selected pieces and eliminated some pieces there. So I think it opens up the door for a lot of strong fintech companies to start promoting federal preemption and a federal license again. We at the MSBA believe in the strength of the state system, and there's many reasons why that's the appropriate structure, but we do understand why they have become, companies become disillusioned, I'll say, with the continued complexity there. I don't see that complexity going away, and I do see the states strengthening their enforcement again to back up what they perceive to be a lack of federal oversight.
Thank you very much. Very, very helpful information and tips there. I do see that as something that's going to come back in maybe full force about the preemption. But let's move along here so we can talk about consumer expectations, so the trends thereof, and regulatory implications. So I know this is a topic that Jim, you and I have discussed many times. There is a lot of data, a lot of information that really does drive also the consumer concerns, understanding the consumer sentiment. So there's a lot to dive into with this topic. So I would like for you to start off, if you don't mind. Let's hear some of your insights. I know we have a few additional slides that go along with this topic also.
Sure. So why is consumer sentiment important, right? And so I just point to a slogan that was introduced with the introduction of the Consumer Financial Protection Bureau, which is a 21st century regulator, right? So the game has changed for consumer sentiment, and it's changed in this way. The Consumer Financial Protection Bureau, although it was given a very large bucket of money, was smart with that money, right? And the way that they were smart with that money is, rather than use a boil the ocean approach, they used what they call consumer sentiment, or in their case, complaints that they inherited from other regulators or other sources, as well as received themselves. They used complaints to discern where there could be harm in the marketplace. And then once they discerned that harm, they would identify the products associated with that harm, and then the companies issuing that harm, and then scope examinations and go in and validate or invalidate whether the consumer sentiment was correct or not correct, and branch out from there. And so it's taken many, many years for the industries to recognize this kind of proactive approach that the CFPB uses to approach harm in the marketplace. And so that's why consumer sentiment and complaints are so important. As Eric and Brandy and mentioned earlier, the complaint space at the CFPB is open for business. As a matter of fact, they recently replaced the "We Are Closed" page with the consumer complaint page. And so now when you go into the CFPB's consumerfinance.gov, complaints are front and center again. And we see that activity continuing. So the premise of what I want to talk about today is, how do we look through that sentiment the same exact way that a regulator does? And how do we get ourselves in the mind frame to say, okay, even though that individual consumer sentiment has already been responded to within the organization and its liability has been put to rest, what can those words that consumers are using through those complaints tell us about where we could have control risk or processes and procedure risk? And so that's really where I think complaints are important, Brandy. And I'll just kind of stop there and see if that sets the stage enough for what we're going to look at in terms of some data related to the money transfer industry.
Yep, most definitely, Jim. So thank you very much. And then would love for you to go into a little bit of background here. And then before we shift gears out to the next topic, Kathy, I would love to be able to hear also your perspective on what you feel the states will or will not do in regard to picking up any additional focus points that maybe were a focus point of the CFPB and where we're headed from a state perspective. But Jim, please go right ahead and let's jump into this slide.
Sure. So let's talk about data, and let's talk about how data is shared. So first of all, a consumer sits at their computer or their telephone, or they write a letter and they submit a complaint to the CFPB. We know that, right? We get them, we respond to them. That's an obvious part of the process. But on the backside, inside the CFPB, we built what are called portals. And those portals are defined as the regulator portal, the state portal, and other municipal jurisdiction portals. And these portals communicate either full jacket or a portion of full jacket complaints, responses, investigations, additional information to the states. So the states have a pipe that runs from the CFPB to the states, so they have access to this data. That's number one, right? And two, the states are starting to learn how to use this data, as I described earlier, to find harm in their marketplace. So a couple of things really quickly is, when consumers file complaints against your company, especially if you're in the money transfer industry, they don't always hit your radar, right? So there are complaints that we'll talk about that named your company and a fact pattern that you never saw. And then we're going to identify that there are multiple types of potential violations within the data, which is unique to the money transfer industry, the broad number of violations, and then where they focus. And then we're going to look at an increase in 2024, which I don't understand, but is there, and we can have a conversation around that. And we're going to show that we've got some concentrations in a few states that increased along with that increase, but at a faster rate. And then we're going to look at some of the top categories for potential violations within the data. So first of all, this is not an advertisement for us. This is a conversation to be able to help everyone understand the environment better. And so my portion of it happens to be in the complaints data space. So imagine our technology and the technology that should be used is, imagine the world's best compliance officer that works 24 hours a day and has 100% recall of their memory, right? So if you take the sentiment that you're receiving for consumers and have that looked at by the best regulatory eyes you can look at, and you discern those fact patterns. They give a pattern, they give a report to you that says, based on consumer sentiment, these are the areas of concern. And that report can be helpful to you in identifying call centers that have a scripting issue, different controls around your organization that might be unintentionally triggering some sentiment issues. And so the FSAI analysis that we use takes all sentiment, including complaints from the CFPB, as well as for clients, their proprietary data, their surveys, their other complaints, everything that they have, and looks at it through the eyes of the regulations, and more importantly, the current regulatory environment, right? So if an enforcement action gets issued, it will look through the eyes of that enforcement action to determine whether the sentiment gives any indications of risk within the company's portfolio at that time. And so that's how this system works. One of the things that the system puts out there is that for money transfer companies, there are many complaints, up to 20% of the complaints received by money transfer or about money transfer related companies don't include the money transfer company in the complaint when it categorizes. So the consumer sits down at their desk and they file a complaint against company X, but in the complaint, they talk about their experience with a money transfer product and use the name of the money transfer company. You wouldn't get this in your portal to be able to respond to this, but it's incredibly important to be able to understand your entire footprint to know that these exist. And you have to look beyond just your portal to look for complaints for your company. And then some of the highest issues that we're finding obviously are identity theft, misleading information, and fraudulent activity. But I want you to understand something when we look at these slides, these are patterns that the consumer is using that are egregious if taken at face value. They align the closest with the regulations. Okay, so if there's 1 million complaints, this system is only going to find those that are exactly or very closely aligned with the language in the regulation itself. And then here on this last slide, you can just see there's an increase from 2024 Q2 to today, and we're seeing that increase continue. And so what's important for money transfer companies is to look at those indirect complaints and to be able to monitor your complaints from a violation perspective, ignoring what the consumer says in their product and issue and sub-issue, but listening to what they're saying. And then here we'll see, this was interesting to me. New York, North Carolina, and Pennsylvania just surprisingly have a higher percentage of misleading information as the population of their state's violation. So the states get this data, the states are looking at this data, the states will use this data to scope examinations. And it's very important as a company to look at this data at the same time through the same lens in the same way to be aware of what they're seeing when they come in.
Thank you. That's some very helpful and very, I think, insightful information there. Kathy, have you heard any more than usual comments, proposed bills, legislation regarding the state side as it relates specifically to customer complaints or anything related?
So in terms of the customer complaints, we have not seen any unusual activity there. We do know that the state system, the NMLS licensing system, has a component with its state examination system to track complaints in a more automated fashion. And, that I think is being slowly, I'll say, implemented. I think states feel more comfortable with their current patterns and resolution for how they want to address the consumer complaints. But that doesn't mean that won't change in the future.
Likewise, I know at the recent conference that many state regulators participated in, one of the themes was that many of the state regulators already have a great handle from their perspective on what's happening in their state with their consumers. So I think they do take pride in really being able to be aware and have controls in place there. With that being said, Eric, I would love to get your perspective on a few things here related to this slide. Can you discuss maybe the status of the CFPB litigation, including maybe rulemaking and enforcement, and give some good insights there?
Disappear. Am I there?
We can hear you. We cannot see you.
Sorry, no, I actually
You're
kicked the cord under my computer, so apologize about that. I was so excited to answer this question. So there are, I think at last count, I'm going to count them. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 cases pending against various CFPB rulemaking. Some of these rules are lucky enough to get more than one lawsuit from different trade associations. And the way it's really worked so far is that the CFPB has really, in most of these cases, only acted when sort of a court deadline is required them to, or that they've wanted to sort of, or that where they've wanted to pause everything while they get their bearings. So one example is around, both around medical debt and overdraft. The bureaus tried to get a stay of those cases while the new leadership has come into place. Interestingly, in the rule that would prohibit large banks from charging overdraft fees in most cases, a consumer group has intervened on behalf of behalf of themselves, I guess, to stand in the shoes of the CFPB in an effort to continue to defend the overdraft rule because they fear the CFPB won't. And they actually filed a brief in that case this week. In some cases, we've seen nothing really happen because there's nothing pending in the case. So, for example, not much has happened in the larger participant rule that would require examination of large digital wallet companies, but there's been activity in Congress to use the Congressional Review Act to eliminate that rule, and that's likely to pass. So those of you not familiar with the Congressional Review Act, it's something that comes up every time there's a change of administration. It allows the Congress, a majority vote in the Congress and the president's signature to invalidate a rule within 90 legislative days of when it's adopted. So the idea is it can get rid of quote unquote midnight rules that the last administration posts or issues in its dying days. And with the CFPB, there were quite a few. So there was rules on overdraft, on medical debt, on big tech. And all of those are focus of Congressional Review Act. So there's gonna be a flurry of activity on those legislative activities in the next month. Importantly, they do not require the filibuster does not the filibuster, which is typically 60 votes in the Senate, does not apply to CRA resolutions. So you just need a simple majority in the Senate. And since the Republicans have a majority in the Senate, and well, as they have a tiebreaker in the vice president, most of these CRA resolutions are expected to pass. And once a CRA resolution passes, the agency, in this case the CFPB, can never issue that same proposal again. So it was used on a rule that I worked on at the Bureau around consumer arbitration clauses, where it was invalidated in 2017. I believe it's 2017. And there's a number of bills pending right now, but the clock is ticking on those. So we expect to see a lot of activity there. And once that's resolved, then I think you'll see probably more debate on structural reforms to the agency. And if I had my magic wand, I would sort of get both sides in a room, because I do think there is some middle ground. I think everyone at some level believes there should be consumer protection, but the problem we've seen, particularly recently at the CFPB, is just it really swings back from one party to the next, and that's just not viable for anyone. If you're trying to plan a business, and we're going to get into how to do that, you can't build a product or build a service where the laws are going to change dramatically every 4 years. It's just not viable and not a reasonable approach. So I'll stop there, but I could probably go on all day.
Yeah, no, thank you so much for that. And with your perspective of rules continuing to change, or what's going to happen between a state and a federal perspective, more federal oversight. What is your thoughts, Eric? Again, if you had that magic ball, what would it tell us about crypto and stable coins? Will there be new federal oversight? Will it replace the states? I'm sure Kathy has a perspective on that from working very closely with state regulators. Is that in the cards for these next 4 years?
So with the caveat that my crystal ball is very finicky.
Yeah.
I would be very skeptical of anything that completely takes the states out of the game. You have a lot of, the way I always look at this at a high level is, Republicans are typically in favor of states' rights and Democrats want sort of one federal system. In some ways, the tables are a little bit turned when we talk about crypto, but I do expect there to be more bipartisan support to sort of create a level playing floor. I think everyone realizes that the way the SEC in particular was handling things the last 4 years is not conducive to building a stable industry. And I also think, maybe this is wishful thinking, that everyone can be in agreement that there's bad practices that we don't want to allow to flourish particularly in the crypto space. And some may argue fraud and theft are already illegal, and you don't need more laws to ban things that have been illegal, since time immemorial. But I think setting more of a level playing field, we've already seen some of that from statements from the OCC, for example, where they've now reversed the Biden era guidance and encouraged national banks to engage in crypto-related businesses. So more guidance like that. I do think there'd be some bipartisan legislation, but promising that in this day and age is a foolhardy endeavor.
Well said. Kathy, do you have anything additional that you'd like to add to that?
So I agree with Eric that it's difficult to predict, but I think we are going to see the states, and they've taken it in small pieces, right? You're seeing a lot of crypto kiosk ATM regulation pop up because that has become, an avenue, I'll say, for fraud. So the states are sort of jumping in, and there's going to be a lot of areas where the federal may set forth some general guidelines, but they're not going to get into the specifics and the details that the state would like to see, again, in order to protect its consumers. So I do think that people are going to have to navigate both sets of regulations, and it's not the most efficient thing to do, but I don't see us getting out of that. In the states, you'll have states that are more informed and understanding of the technologies than others. So I do envision us having a patchwork. We talked about the MTMA earlier, and part of that model law had a chapter 13 that talked about virtual currency. That chapter was based on NUL's determination at the time, NCL's, I guess, National Consumer Law Division at the time, because it had taken us 18 months of regulator and industry conversations to get to the MTMA. And we wanted to get something out to the states, and there was no way we could begin that discussion on virtual currency. So many of the states left that provision out as they passed it. Of the 24 states that I spoke about earlier, I think only 2 states have had that provision. So we will see, I believe, a lot more state-specific regulation there. And it is a topic because the Trump administration speaks about it, that we'll see state legislators taking up. It's not, they seem to sort of follow the leadership's view on a topic and try to implement legislation that's specific and helpful from their state perspective. So, we're almost out of sessions this year, so we're not seeing a ton, but I would prepare us for next year where we're going to see a lot more state legislation around this industry.
Most definitely. And I think there's also a lot more concern and awareness regarding AML, anti-money laundering, or KYC, or know your customer obligations under these evolving regulations. So Eric, would you like to maybe give us a little bit of thoughts or insights about the new GTO and other fencing guidance?
Yeah, so happy to do so, Brandy. Thank you. And so obviously a focus of the new administration at the federal level has been on illegal immigration. You've seen some discussion last week on foreign gangs and their presence in the United States. And obviously, a lot of the focus of the anti-money laundering laws is preventing and removing criminal movement of money in our financial system. And a lot of that, particularly to Latin America, in the opinion of the administration, is done through non-bank money services businesses. So there was what's called a geographic targeting order, which from FinCEN, which is the federal AML regulator, that imposed new currency transaction report requirements on a number of zip codes along the southwest border in, I guess it's Texas and Arizona. I'm forgetting the states, but it's not the entire border, but it's select zip codes that you can find on FinCEN's website. And that for 180 days, beginning from the effective date, which is in early April, changes the transaction reporting threshold from $10,000 to $200 in those zip codes. So for many money transmitters, they probably did very few, particularly if you're doing consumer money transmission, did very few, if any, transactions that crossed that $10,000 threshold. But probably a very large number of their transactions were over $200. So it's going to substantially expand the number of transactions that they're going to be required to report on. And I would expect the federal regulators to pay a very close attention to whether entities are accurately complying with this new order. And also, we're expecting it to be expanded to other zip codes. This is probably a bit of a test because they didn't pick every zip code along the border to see how it works, and also expecting it to be extended beyond 180 days. The way the rules are, they can do it initially for 180 days and go on from there. But it's quite a bit of work, particularly if you work with agents where you have to implement these additional information gathering and reporting steps at an agent level to develop the infrastructure to do that, train your agents, and get all that set up by early April.
Yeah, I think this goes very well into risk mitigation strategies and really testing, many of these, companies that do operate and being able to, make these adjustments, being able to, swiftly comply, with these, changing requirements. With that, I want to go to this next slide here because I would love, Jim, for you to be able to, weigh in here because, the more we discuss, just, risk mitigation, managing, all there is from a regulatory and governance perspective, you're really needing more and more to rely on tools and technology. And so from your perspective, what would you say is the role of AI in compliance risk management going forward and going into the future? And do you see it being necessary or a nice to have? I would love your thoughts.
Sure. So I think AI is really important. And obviously, we use AI extensively here in our shop, and I think the world of it. AI is not the answer to everything, but one area I think AI is really an example for an area that can be used is in consumer financial companies. Sometimes we grow to the size either in transaction volume or in customer base, but it's very hard to listen to the customer. And the customer is speaking on a regular basis. And so, as we talked before, really listening to that customer in order to identify risk in its infancy before it becomes systemic is incredibly important. I think that, looking at the slide here, when we talk about enforcement actions and against fintechs and the role of AI, I think we're seeing an environment that is very confusing. On one hand, we're seeing some opportunities at the federal regulatory side where they may not be as aggressive in adding new rules or making changes to rules. We see an increase or a step up, if you will, at the state level. So what will that do to growth and innovation? And so I have the tendency to look at Congress and say, what is Congress doing and what are they imposing? And we look at the debanking legislation and we see the attitude that Congress is taking towards stopping different industries from having banking services. That's going to be important moving forward. And we look at some of the other aspects of debanking where Elizabeth Warren would like to wrap in consumer protections in debanking and have appeals processes for accounts that are closed. But I think the role of AI is important in listening to your customer in real time And then I think it can be applied in decisioning in certain areas where there isn't direct consumer connection, right? So some of those internal decisions and controls can be automated through AI as well, but it's in its infancy, and I'm really excited to see where it's going to go.
Perfect, thank you. And so, Eric, one question here on the screen is, will there be more enforcement actions against fintechs? And earlier you indicated that in the prior Trump administration, that there were actually more enforcement actions, maybe for a technical perspective, than there were in some other administrations. So do you have any additional thoughts on that question there? Anything that you'd like to elaborate on?
So sure, one thing we've seen and there's been some reporting on is that some of the state regulators, just as they did last time Trump won, they have enhanced their ability to bring enforcement action. So we've seen some high-level CFPB officials move into the New York Department of Financial Services, for example. And the CFPB's dismissed a number of cases. There's cases that are sitting out there. If someone wants to pick it up, redraft it under New York law or under California law. And it's not so hard to adjust that lawsuit and refile it against those companies. Obviously, you have a different setup when you're looking at a lawsuit at the state level, but you can see a number of cases, for example, where states will work together to bring out enforcement action. And I certainly expect that to happen. Now, states don't have the same resources as the federal government. They have different interests, and they have different focuses. But I almost certainly would expect to see more states filing actions against fintechs, whether it's around unlicensed money transmission, whether it's around unfair competition laws, which is sort of the state version of UDAP. And they also, in many cases, states can enforce the federal consumer finance laws or have their own versions of them. So certainly expect to see a lot of activity at the states. And, as I said earlier, the two cases at the federal level that the CFPB has continued both involve the Military Lending Act, which limits the interest rates you can charge service members and their dependents on certain types of credit. And I would, I think you can take from that with we may see other MLA actions in the future. That's always been an area of quite a bit of focus, even though ironically, when the MLA was passed, it didn't get any Republican votes. But really, I think we won't know for sure what level of enforcement we'll have from the CFPB till we know how many enforcement attorneys are left after the litigation resolves itself in the next few weeks. The prior director, Director Chopra, made a big deal of adding 50 enforcement attorneys. So part of the reason they're making a big deal of ramping down is to sort of counter that. But once it settles out, we know how many people are there, we'll have a better sense of how many cases we can expect them to bring. And I do think that those more technical cases that are less controversial are easier to bring, and it also makes them look like they are being active, even if they're not bringing sort of the big industry moving types of cases.
Perfect. Thank you so much for those insights. I do want to shift gears here in just a moment to our next slide, which is a case study. But just to note, we have covered much of this information throughout our discussion so far. We've discussed some regarding the state regulatory challenges, the patchwork of licensing requirements. Kathy mentioned the model law. We've also discussed, is there potential for some federal preemption? I would say also from the trends in the state AG enforcement actions, we didn't necessarily speak to AG specifically. Eric, I'll let you comment on that in just a moment when we go to the case studies, but I do want to just put a plug in for MSBA in that, it is invaluable for being able to monitor the state legislation, what's happening. There are so many bills out there, so much happening, that even if you are not a money services business, but you are servicing one from even like a banking perspective, there's a lot of valuable insights there. With that being said, I want to move here to have time for just a little bit about a case study so that we can hear what's happening in the industry. Eric, I think you have some bullets here that you're going to highlight of a recent case.
Yeah, so there's a couple of cases I've sort of hinted at them already. One involving a company called MoneyLion, which the CFPB brought in 2022, but stayed for a little while and came back to life late last year. And MoneyLion first is being alleged of violating the Military Lending Act in lending to service members above the 36% military APR rate. MoneyLion, I think in its defense, argues that it wasn't really extending credit because it had a non-recourse product. And those of you working in the earned wage access space in particular are familiar with those sorts of arguments that those products are not credit. But MoneyLion also was alleged to have, or is alleged to have, or have had a membership program that was very difficult to cancel, particularly if you had not paid off a transaction. And we've seen a lot of focus in the last couple of years, both in clients that are developing membership programs and in the government and regulators in bringing cases against entities that make it very hard to cancel those membership programs. And we've all probably enrolled in one of those ourselves. So there's a very public case involving Amazon, which allegedly made it difficult to cancel one's Prime membership. And the same allegations here against MoneyLion. And the FTC also has similar cases that it's brought. For example, there's a case last year against Bridget, which is a similar sort of short-term liquidity provider. The other case that the CFPB has not dropped is a case against a company called First Cash, which again did palm loans and other sort of short-term lending products, and is again alleged to have violated the Military Lending Act and have breached a prior consent order with the Bureau. I want to note, like, we've talked a lot here about the CFPB and its future is in doubt, but the other regulators are still going strong. And the FTC, albeit having fired its 2 Democratic commissioners this week, is continuing to bring forward consumer protection actions, and virtually all non-bank companies, including those we're talking about today, are subject to FTC oversight, and they're very focused on products that are unfair to consumers. So there's been a high-profile case involving a fintech called Dave, where Dave solicited tips in ways that is alleged to have been unfair to their customers because it wasn't clear that you couldn't not provide a tip, for example. And that case is continuing to be prosecuted by the Department of Justice, having moved from the FTC. So a lot of focus on products, again, where consumers can't cancel, where it looks like service members are being taken advantage of. Less focus, I think, on companies that are being more innovative and bringing more innovative products. So I don't think we're going to see the CFPB, for example, directly take on whether earned wage access is a loan, and we're likely to see the buy now, pay later rule go away. But things that strike you as wrong and look like fraud and look like crime, those things, as I said before, have been illegal long before any of these agencies existed, and we're still going to find regulators pursuing those sorts of cases.
Perfect. So I would like to open this up for any questions. So if you would, you have questions, please put those in the chat, and we will try to make sure that we get to those. We do have a few that I will run through to see if we have covered all of those that were pre-submitted questions. While I am looking at those, I would like to just give just a few seconds, kind of a round table to each of you. Let us know, what are your thoughts? What can we expect to see this year, in your opinion, as being the top concerns within the industry, or the focus points, anything that's top of mind for you? So I'd love to start, Jim. What would you like to have as your lasting remarks before we go into questions and answers?
Yeah, I just want to know from Eric, in terms of the rules the CFPB is looking at, what's the difference between a required rule and an interpretive rule? And can you talk a little bit about the prediction for 1071 and 1033, just real briefly?
Sure. So an interpretive rule is basically guidance from the agency, an interpretation of an existing rule. So that's what the Bureau did in connection with buy now, pay later. It also proposed an interpretation with respect to earned wage access. Those rules can be eliminated with a swipe of a pen, basically deleted by a new regulator. The legislative rules, which are the ones that go out for notice and comment, are hundreds of pages long. They typically require another rulemaking to repeal them. You can't just change your mind and pull those back. So that's why many of those are caught up in litigation, because the new director can't wipe out 1071 or 1033 with the stroke of a pen. And there's a lot of complexity there. I think what we will see, particularly 1033, if I had to guess, is we will see postponement of the effective date because of all this chaos. It takes a lot of work to implement the requirements. Postponement of the effective date while the agency reconsiders some of the open questions and industry pain points that have come up over the last year. At 1071, I think people are really frustrated by it. So I would expect the Bureau, in connection with pending litigation, to make that go away, notwithstanding the statute that requires them to do a 1071 rule. So we could do a whole webinar on those two. That's very good.
Thank you so much. Kathy, do you have any closing thoughts?
So I would just say my closing thoughts, as you heard today, that we don't have a crystal ball. There is a lot going on. You know, I'm most concerned here at the association with taxing of services that's occurring in the states right now, how that will affect consumers in terms of additional expenses that they will have to pay to cover those. There's also there's a couple states that are requiring citizenship verification that we are pushing back on. In our detailed conversations, I think it's important that we communicate out about how regulated our services are. I do find that many state legislators, excuse me, do not understand that we have BSA and AML obligations. So I think it's always important in your communication out to identify how regulated your services and products are and how important they are for all consumers. So that's my message to help you push and carry out. And as Brandy noted, we do a lot here at the association on behalf of the industry. We always encourage people, if you want to dial in to kind of understand what's happening for a test run, we're welcome to that. So please check us out.
Thank you so much. And there are a couple of questions. I think we've got about 3 minutes left. So I want to see if we can at least answer one of these. Do you foresee AML controls becoming more lax under the new administration, or will there be an uptick in regulation? So anyone, feel free to give your thoughts on that one.
Yeah, that's the one area I would not expect controls to be dropped generally, particularly in the areas we've talked about in connection with the geographic targeting order, money services businesses that are serving, what I would say are areas disfavored by the current administration. On the other hand, we've seen changes at the corporate level. There's the corporate reporting rule that FinCEN said folks don't have to comply with. So it could go in both directions, but I don't think it's going to be single path towards deregulation. And I would not prepare for deregulation before it happens, particularly in the AML area.
And I would say probably the same from just everything I've heard in the industry, also with regard to sanctions as well. It seems like that's not one to be expected to have any deregulation in.
Brandy, on the sanctions, I would just add in that we may see them become more complex in terms of how they have to be incorporated into your program with some of the executive orders and the designation of, for example, cartels as terrorist organizations. So, staying on top of those are really important.
And so that'll lead into our final question, then we'll end. What are the less obvious risks exposed to the parties involved in fintech business relationships? So any short answers here? I know we could probably go long. Jim?
Just unintended problems. The risk is something went off the rails, and you have to be able to see it before it gets systemic. That's really where I focus.
Google Synapse.
Yeah. that is a good one. That's probably a very good spot to be able to end here. I would like to take just a moment to thank again our panelist, Eric with Ackerman. Thank you so much. Provides invaluable legal advice that's industry specific, which is always very, very, very important, especially for those entering the space that need legal counsel. We have Jim McCarthy, brilliant when it comes to anything related to fully understanding the data behind the consumer sentiment. So thank you so much for sharing some of the slides and the insights into how you take this data and make it useful, make it valuable to these companies. And Kathy, we love everything that you're doing with MSBA, keeping us straight when it comes to all the state requirements and what's happening with everything from model law to those very nuanced requirements and changes at the state level. So thank you all very much for your time. We will try to follow up with everyone who joined today with an email and letting you guys know also about future webinars. Thank you for your time.